Right now, somewhere in this country, someone is lying awake at night, staring at the ceiling, thinking about their bank account. And statistically, the odds are very high that person is financially average. And average when it comes to money in America is a genuinely scary place to be. 1 in 4 Americans has zero saved for retirement. Zero. The ones who do have something saved, the median balance is $65,000. And by the time most people are approaching retirement age, the typical balance is $88,000, which works out to less than $300 a month if you follow the standard withdrawal rule. $300 a month. After 40 years of working, that number should stop you cold. And if it doesn't, if that sounds okay to you, then this video is going to be very useful for you today. Because most people have no idea what average actually looks like with money. They assume everyone else has their act together. They scroll through social media, see the vacations and the new cars, and figure the people around them must be doing fine. So they don't feel any urgency to change their own habits. Today, I'm pulling back the curtain on the real numbers, income spending, savings debt, retirement, credit scores, net worth, all of it. Some of what you're about to see will make you feel better about where you stand. Some of it is going to be a wake-up call. Either way, by the end of this, you'll know exactly what average costs. And you'll have a very clear picture of whether you want to be average or whether you want something different. Let's start with income, because everything else in your financial life flows from this. The median full-time worker in America earns around $52,000 a year, before taxes. That's roughly $1,000 a week, which sounds okay on the surface. But here's where most people make their first big mistake. They think in terms of their salary instead of their take-home pay. Because that $52,000 doesn't stay $52,000 for long. Federal income tax, state tax, Social Security at 6.2%, Medicare at 1.45%, health insurance premiums. After all of that, the average full-time worker is walking away with somewhere between $35,000 and $40,000 a year in actual take-home. Break that down and you've got about $3,000 to $3,300 landing in your bank account every month. $3,000 a month. That's the real starting point. That's what the average American worker actually has to cover rent, food, transportation, debt payments, and somehow still find money to save. Think about that for a second. $3,000. That's it. That's what average looks like before a single bill gets paid. Most people anchor their spending decisions on their gross salary. I make $52,000. I can afford this. But you don't spend your gross. You spend your take-home. That gap between what you think you have and what you actually have is where the first layer of financial stress gets created, and it compounds every decision the average person makes from there. And when you see what the average household is actually spending every month, you'll understand immediately why $3,000 take-home is already a problem before a single dollar gets saved. Here's where things get uncomfortable. The average American household spends about $5,500 every single month. $66,000 a year walking out the door. Hold those two numbers next to each other. $3,000 a month coming in for the median worker, $5,500 going out. That's not a small rounding error. That's a structural gap that the average household fills with credit cards and optimism. So where does $66,000 a year actually go? Housing takes the biggest bite, about $1,900 a month. Rent or mortgage, property taxes, insurance, utilities, basic maintenance, $1,900. And if you live in any city where jobs actually pay well, New York, LA, Austin, Seattle, Boston, $1,900 might get you a one-bedroom. In some of those markets, it won't even do that. Transportation runs about $900 a month. Car payment, insurance, gas maintenance, registration, $900 a month just to move yourself from one place to another. Most Americans treat a car payment like it's as permanent and unavoidable as oxygen. It's not. It's a choice. And it's a $900 a month choice that quietly blocks a huge amount of wealth building for the average person. Food comes in around $700, groceries and dining out combined. Healthcare and insurance add another $500, and that number has been climbing every year. And here's the part most people don't realize. Just housing, transportation, and food alone already costs about $3,500 a month. And median take-home is $3,000. Let that land for a second. The typical American brings home $3,000 a month and needs $3,500 just to cover the basics. Before anything else exists in their budget, that's not a spending problem. That's a structural impossibility that the average person is living inside right now without fully realizing it. That $500 monthly gap between what comes in and what goes out, that's the engine driving the average person deeper into debt every month. Not recklessness, not stupidity, just math that doesn't work. And here's the part that really stings. Most people living inside these numbers don't know the gap exists. They just feel a low-level financial stress they can't quite explain. They feel like they should be doing better. They're not sure why they're not. Now you know why. But knowing the spending gap is just the beginning. Because the number that actually seals the average person's financial fate isn't how much they spend, it's how little they save. Here's the number that determines your financial future more than almost anything else. The average American saves about 6% of their after-tax income. 6%. On a $40,000 take-home, that's $2,400 a year going into any form of savings at all. Emergency fund, retirement, account down payment fund, everything combined. $2,400 a year to cover every financial goal you have between now and the end of your life. Let me show you what that $2,400 is competing against. The average home down payment runs around $60,000. At $2,400 a year, saving for a down payment alone takes 25 years. 25 years just to buy a house. And during those 25 years, you're also supposed to be funding retirement, building an emergency fund, replacing a car when it dies, handling whatever life throws at you unexpectedly. That's the reality of what 6% savings actually looks like when you run the math. Not a number on a paycheck. 25 years of waiting just to afford a down payment. A replacement car averages close to $48,000. A basic kitchen renovation runs $25,000 to $30,000. These aren't luxury purchases. These are predictable, inevitable life costs. And at 6% savings, you can't fund any of them without borrowing. This is why the average person is always playing financial catch-up. It's not bad luck, it's arithmetic. Financial professionals say you need to save at least 15% of your income, specifically for retirement, on top of everything else. The average person saves 6%. That 9-point gap compounded over a 30-year career is the entire difference between retiring with real options and retiring with $88,000. And I want to be honest with you about something before we go further, because I've lived this gap personally. For a long time, I was exactly this person. Steady job, paying bills on time, contributing 3 or 4% to a 401k, because that's what the onboarding paperwork suggested, and I never changed it. Not visibly broke. Just no real savings, no plan, no idea what my net worth was because I was afraid to calculate it. Then everything hit at once. Car needed major repairs. A medical bill showed up that insurance didn't cover. I sat down one night and added up what I owned versus what I owed. And I had about 2 weeks of expenses in accessible savings. 2 weeks. After years of working full-time, I wasn't in crisis. But I was one bad month away from one. That was the moment I stopped assuming I was fine and actually looked. What I found was that I was perfectly, completely dangerously average. Not failing, just average. And average, I learned, that night has a very specific and uncomfortable destination. I'm telling you this because the statistics we're talking about today don't happen to reckless people. They happen to people doing their best with the information they have. The problem isn't character, it's awareness. So let's talk about the retirement numbers in detail, because this is where the average person's financial story gets genuinely alarming, and where most people have absolutely no idea how far behind they actually are. The median retirement savings for Americans who actually have a retirement account is $65,000. But that number hides something worse. About 1 in 4 Americans has zero saved for retirement. Nothing. No 401k, no IRA, no anything. 1 in 4 people is planning to stop working someday and fund it entirely through Social Security. We'll get to what Social Security pays in a minute. It's not good. For people who do have accounts, here's where the average person actually stands by age. Under 35, median balance around $13,000. Mid-40s, roughly $80,000. Late 50s, the final stretch before retirement, about $135,000. Now here's what those numbers need to be. The commonly used benchmark says you should have roughly 1 times your salary saved by 35, 3 times by 45, and 8 to 10 times by retirement. At the median salary of $52,000, that means you need somewhere between $400,000 and $520,000 saved before you stop working. The average person in their late 50s has $135,000. Stop and sit with that number for a second. $135,000. When they needed $400,000 to $520,000, the average person is heading into retirement with roughly a quarter of what they actually need, and most of them don't know it yet. That is not a gap, that is a canyon, and most people don't fully see it until they're standing right at the edge of it, doing the math for the first time, realizing the numbers don't work and that there's not much time left to change them. Now, If retirement savings look that bad, you'd think people at least have Social Security to fall back on. So, let's talk about what Social Security actually pays. Because this is where the picture gets even darker. The average monthly benefit right now is around $1,550, $18,600 a year. In most of this country, that is survival level income on a good day. It does not cover a comfortable retirement anywhere people actually want to live, and $1,550 is the average. If you had years of low-income gaps in work history or you claim benefits before full retirement age, your check could be significantly lower. Some people collect $800 or $900 a month, $900 a month. In 2025 America, that's what retirement looks like for a meaningful portion of the population, and it's what the average person is drifting toward without a plan to avoid it. Here's the timing trap that most people don't see until it's too late. The average American retires at 61. Full Social Security benefits don't kick in until 67. That's a 6-year gap, no paycheck, not yet at full benefits, funded entirely from whatever savings you have. If the average person near retirement has $135,000 saved and needs to cover 6 years of living expenses before full benefits start, they burn through most of it before Social Security even begins at the full rate. And then once benefits do start, once you're on $1,550 a month plus whatever remains of your savings, you might need that to last 25 years. Because someone reaching 65 today has a life expectancy that puts them in their mid-80s. 25 years of retirement, near empty savings, a monthly check that barely covers the basics. And here's the question nobody wants to sit with. Of those 25 years, how many are you actually going to be healthy enough to enjoy? At 61, you might feel great. But at 71, 76, the things you can do at 65 are not the same things you can do at 75. The experiences you want to have don't wait for you to get your finances sorted out. The average person works for 4 decades and retires just in time to not really retire. Now here's something most finance videos skip completely, a number that's been quietly costing the average person tens of thousands of dollars in the background this whole time. And most people have no idea it's happening. The average FICO credit score in America is around 715. On a scale of 300 to 857, sits in good territory. And honestly, given everything else we've looked at, the debt, the thin savings, the spending gap, 715 is better than you might expect. But here's what 715 actually costs you. The difference between a 715 and a 765 credit score on a 30-year mortgage can easily be $40,000 to $60,000 in total interest over the life of the loan. Same house, same bank, completely different total cost because of a number most people barely think about. $40,000 to $60,000, gone, silently, because the average person treated their credit score as an afterthought instead of a financial tool. Your credit score affects your mortgage rate, your auto loan rate, your insurance premiums in most states, and in some cases, whether a landlord rents to you at all. It is one of the most consequential numbers in your financial life, and most people treat it like a background detail they'll deal with someday. The rules aren't complicated. Pay every bill on time. Don't max out your cards. Don't open new accounts constantly. That's most of it. And yet a significant chunk of the population sits in the 500s and 600s, paying higher rates on everything month after month, year after year. Bad credit isn't just embarrassing, it's expensive, in a way that compounds quietly while life is happening around you. But if a subpar credit score is expensive, what the average person is doing with credit cards is in a completely different league. This is the number that's actively running their finances in reverse. The average American household carries over $9,000 in credit card debt, at rates between 18 and 26% annually. $9,000 at 20% means $1,800 a year in interest charges, just to stay where you are, not reducing the balance, just servicing the interest. $1,800 a year that builds nothing, creates nothing, goes directly into the credit card company's profit. Here's the math that really stings. Carrying $9,000 at 20% with minimum payments takes over 15 years to pay off. 15 years. And by the end of it, you'll have paid more in interest than the original balance you charged. 15 years of payments for things that are probably already worn out, eaten, or forgotten. That is what the average household's credit card balance actually costs, and most people carrying that balance have never once calculated it. Where does that $9,000 come from? Sometimes genuine hardship, medical bills, job loss, unexpected repairs with no savings to cover them. Those are real. But a meaningful portion accumulates quietly through restaurants, clothing, electronics, online shopping subscriptions nobody remembers signing up for. Not one big mistake. Just the slow drip of spending slightly more than you have month after month until the balance becomes something you stop opening the statement to see. The rule is simple. Even if it's hard, pay the full balance every month, every time. If you can't pay cash for something, you can't afford it right now. And if you're already carrying a balance that is your number one priority, before investing, before a house down payment, before anything, there is no investment available to the average person that reliably returns 20% a year. Paying off 20% debt is the best guaranteed return you will ever have access to. That's not an opinion, that's arithmetic. Now take everything we've covered: income, spending, savings rate, credit score, debt, all of it. There's one single number that wraps all of it up and tells you exactly where you actually stand. And most people have never calculated it. What you own minus what you owe. Home value, car bank accounts, retirement accounts, minus mortgage, car loan, credit card, balance, student loans. Whatever's left is your real financial position. The median net worth for American households is around $122,000. But by age, here's what it actually looks like. Under 35, around $13,000. 35 to 44, $91,000. 45 to 54, $168,000. 55 to 64, $212,000. 65 to 74, around $266,000. Here's what I find genuinely interesting about those numbers. They're reachable. You don't need to start a company or get lucky in the market or inherit anything. A normal income combined with consistent behavior over a working lifetime can hit every one of those milestones. The problem is, most people never calculate this number, not once a year, sometimes not ever. They operate on a vague sense of, I think I'm doing okay, and that vague sense is exactly how the average person ends up at 60 with $135,000 when they needed $500,000. You cannot correct a number you're not measuring, and the average person never measures it. Here's the good news, and I mean this. Everything we just looked at is completely beatable, not with some complicated strategy, not with a higher salary. The bar to beat average is lower than most people think. Let me show you exactly what that looks like. Every stat we looked at today, the $88,000 in retirement, the $9,000 in credit card debt, the 6% savings rate, the credit score at 715, all of it is beatable. And beating it doesn't require extraordinary income, perfect discipline, or secret knowledge that only wealthy people have access to. It requires being slightly more intentional than average, consistently. Over time, that bar is genuinely low. Here's exactly how low. The average person saves 6%. If you save 10, you're already ahead of most people you know. If you save 15, you're operating in a completely different financial tier than your peers. The average household carries $9,000 in credit card debt. If you carry zero, if you pay your balance every single month, you're already miles ahead. Not because you're doing something complicated, because you're not doing the thing that costs most people $1,800 a year while building nothing. The average person has no idea what their net worth is. If you calculate yours today, even if the number is uncomfortable, especially if it's uncomfortable, you're ahead because you know your starting point. Here's what slightly better behavior produces over time in concrete numbers. You're 28 years old. You find a way to redirect $1,000 a month toward investing. Cheaper apartment, no car payment, fewer restaurant meals, cutting forgotten subscriptions. $1,000 a month into a low-cost index fund, averaging 7% annual return. By 30 years later, that single habit produces just under $1,200,000. One decision, $1,000 a month, 30 years of consistency. The average person never runs this math. They buy the newer car because they work hard and deserve it. They take the nicer apartment because they've earned it. They eat out because they're tired. And every single one of those choices feels completely reasonable in the moment. None of them feel like a mistake. But the accumulation of individually reasonable decisions is exactly why the median person approaching retirement has $135,000 instead of over $1 million. Not one big failure. 1,000 small choices, each of which made perfect sense at the time. It's not about finding the right stock, not about timing the market, not about some shortcut. It's the boring, unglamorous, repetitive habit of spending less than you earn and investing the difference. Every month, through good years and bad years, for decades, that's the whole game. The people who retire with real options didn't do something magical. They just did the boring thing consistently while everyone around them was doing the reasonable thing. Every number we looked at today represents millions of real people. People who got up, went to work, paid their bills, and genuinely believed they were doing okay. who ended up on the wrong side of these statistics, not because they were reckless, but because they never actually looked at the numbers while they still had enough time to change them. You just looked. And that matters more than most people realize, because most people never do. So here's what to do with this. Tonight, calculate your net worth. Write it down, figure out your actual savings rate. If you're carrying a credit card balance, make paying it off your #1 financial priority above everything else. Then find 1% of your income to redirect toward investing. Do it. Then do it again in 6 months. None of this is complicated. It's just something the average person never gets around to doing. And the moment you start doing it, you're no longer average. Small moves, consistent, over time. The average person is going to watch this feel uncomfortable for a few minutes and go back to exactly what they were doing before. Because average feels okay when you're living inside it. But you've seen what average actually costs. 40 years of work, $88,000, $300 a month. You know the number now. What you do with it is up to you.